Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I wade into the political debate right before the election that's upon us. But it's not what you think. Rather than discussing our political ideologies, we talk about how investors shouldn't let politics influence their investing decisions. From the historical market returns under Democrats or Republicans, to the actual long-term economic impacts of policies and political views, investors are best served by not letting their support, distaste, emotions around one political party or another influence how they are investing now and in the future. As always, thank you for listening. We hope you enjoy the discussion. All right, today you and I are going to have a debate around who is going to be the next president of the U.S.
No, we're not going to do that.
No, I'm just, but we're not going to do that because people don't want to tune in to our podcast to listen to us debate about politics. But we are going to talk about politics today, but we're going to talk about the importance of separating politics from how you manage your portfolio. And, I think this is somewhat hard for a lot of investors to do. I feel like the world we live in today with politics and how maybe polarized things are in people's opinions, and also the behaviors of just politicians in general, and not just talking about like Trump, it's a lot of them. It results in people, I think, having strong opinions, being worried, digging into their beliefs and all that kind of stuff. And so a lot of times for investors that can feed into how they sort of look at having their investments either managed, or how much cash they have in the market, or what they're doing with their investments or whatever. So we're going to talk about the reasons why you shouldn't do that. And maybe to start, Jack, I'll let you sort of talk about what the actual data shows in terms of, does the market actually perform better under a Republican administration, like a lot of people might think, or what is the actual data show and what does it bear out?
Just to take a step back and highlight what you talked about, all of us have strong political beliefs. I mean, some people are in the middle, but many people are polarized these days, but everybody has strong beliefs about the way they think the world should be. And there's this tendency to take that and to translate it into the stock market. And so to think, if this candidate represents the way I think the world should be, then this candidate also represents a higher stock market. They're also better for the stock market. And that's the part that's very hard for a lot of investors, is to separate my strong beliefs about here's what has to happen in the world with what's going to happen in the stock market. And to your question, when you look historically at the stock market and say, has it done better under Democratic administrations, or has it been done better under Republican administrations? It is done slightly better under Democratic administrations, which is counterintuitive to a lot of people, because typically you would think, lower capital gains taxes, less regulation, Republican administrations would be good for the market. But I'm also, after saying that, going to tell you why that doesn't matter at all, because I wouldn't put really any weight in that data. And there's a couple reasons for that, which we'll get into. But so in general, the market has done better under Democratic administrations. But one of the interesting things is when you dig into the data, and you separate it into unified Republican administrations, meaning both houses of Congress and the president were Republican, unified Democratic administrations, and then divided governments with a Republican or a Democratic president, you sort of get different results. So a unified Republican administration and a unified Democratic administration have produced the same exact annual return. So there's been no difference whatsoever when Republicans were fully in power or when Democrats were fully in power. The difference has all come when there's been a Democratic president, but a divided government. And the returns have been much better there than when there's been a Republican president and a divided government. And so historically, there's probably not too much to tell you that we want either kind of president from the perspective of the market.
Yeah, the only thing I would say to that is a lot of times, at least I hear this, I don't know if you hear it, but I hear the market likes divided government because the market at least some investors think that, because when you have divided government, you have less maybe got the government hands kind of, influencing things, and not one party can't just, jam down their policies and their beliefs. And so, you hear that a lot, that like the market likes that, but we don't want to read too much into the data. The number of years where you had a Republican president and a divided government, you had 33 of those total years going back to, I think, whatever your chart is in here, going back maybe 70 years or something like that, or 80 years. And that was by far the worst performance of the market when you had a Republican president and a divided government. So it's not always true that the market, at least historically, when you look at the data, it hasn't played out.
Right. And we'll put a link to this article in the show notes, but even when you bring in the divided government with the Democratic presidents as well, the average returns of the market with a divided government are actually less than the average returns of the market with a unified government. So this plays in the same thing we were talking about, which is, people want to say, all right, Republicans are better for the market, or Democrats are better, or divided markets are better, divided governments are better. There's really nothing in this data to say anything about that. And the other point I think is really important to make is, if you look at what we're dealing with here, we're dealing with something like 80 years of data or whatever's in here, but I think you're dealing with something like 17 administrations. So if you look at this purely from a statistical standpoint, my N, or the number of observations in my sample, is like 17 different presidents. If I was looking at that on the other side of our business, where I'm judging value strategies and things like that, I would say there's absolutely nothing no conclusion I could possibly draw from a sample that's that small. And so I think no matter what it says in the data, even if it said, and it doesn't say anything strongly, but even if it said strongly, it's better with Democratic administrations or it's better with Republican administrations, I probably still wouldn't read anything into it, because there's just not enough data to say to say that one way or the other.
Yeah, we need like 80 more presidents to have any even statistically significant, sample size to make any judgment on that. Another thing that you hear a lot is, when the market's up and you have a sitting president, a lot of times they sort of take credit for that. And a lot, in the markets, it's not like a lot of the policies in many cases, that are put forth, don't necessarily have a lasting sort of impact on the market. But the one thing I would also say to that is, if you think about the one thing that Trump did do with lowering corporate taxes, that is something that, directly made companies worth more. Because if you go from a 35% tax rate to a 21% tax rate, those companies clearly that were paying the higher tax rate, now that they're on the lower tax rate, they're, keeping more of that, of the profit. And I mean, I remember when that was enacted, Buffett called that just like a gift from the government, in the sense of, corporate profitability, for those companies that were benefiting from that. But that's not the bigger point here is the role of good luck or bad luck and the performance of the market during a president's time in office. So do you want to I think you had a really good example in your article, sort of highlighting two different presidents and how, when they came into office, had a huge impact on the performance of how the market performed during their administration.
Right. So if you and I are going to invest for an 8-year time frame, and we just pick a random time frame to invest in, probably the biggest determinant of how we're going to do is what was the valuation going into that time frame. And so what was going on with the market before that? And so a good example of that is Obama came into office essentially at a market bottom. And so obviously Obama is going to have above average returns during his administration. Now, if another president comes in, at a market top, he's obviously going to have below average returns. And that has nothing to do with their policies. It's not saying their policies were good or their policies were bad. It's just the luck of when you start has a huge impact, and the valuations you start at and the economic situation you inherit plays a huge role in the return of the market during your administration. And the other part of it is, a lot of times these economic policies that administrations enact have a lagging effect. I mean, you gave the example of Trump's tax cut, which had a fairly quick effect in terms of profits in the market. But a lot of these other policies, can have a lagging effect. So what you can have is one president can inherit the either good or bad effects from another president. And so a lot of times when you're judging the president during their own administration by how the market did, they may have had great policies for the market, but those policies may have had their impact after them, or they may have had horrible policies for the market. But again, those terrible impacts could have come on after them. And so what I'm getting at is a lot of this is to do with luck in terms of what they inherit, and also timing in terms of how long it takes the policies to go into effect. And people end up getting credit for things they don't deserve credit for.
Yeah, and even in the case, it's not only when you start, but also maybe when you end, because in the case of George W. Bush, which we had a chart in the article here, he came into office right in the middle of the 2000 to 2002 bear market, and then he basically left office at the end of '08. So as many investors probably remember, at the end of '08, the fall of '08, I mean, the market was, down, I don't know, maybe like 30 or 35%, because that was right in the middle of the great financial crisis. So, the market was barely above break even well into his administration. And then, it took another huge hit. And then, like you said, Obama came in and got the benefit of being, inaugurated right after the market bottom there in '09. The other point I think you were making in the article was, the changing tide of sort of policy, and how I think what you were trying to get at here is, that different policies can have different impacts, like you were saying, like some short-term, but mostly long-term impacts on the market. But the difference in those policies sometimes can, maybe be less impactful as they cancel each other out. Is that what you were trying to get at there?
No, what I was saying is people sort of assume that, a Republican policy, for instance, of lower taxes is good for the market. And, that's probably very true. Obviously, when you cut the corporate tax, profits go up. I'm sure that's contributed to the market going up. But we're sort of in a different place right now, because both parties have embraced the use of debt and fiscal stimulus into the economy. And so you're probably going to see a lot of that no matter who wins. And you're probably going to see a lot more of that if a Democratic administration wins. And so, whereas lower taxes are good for the market, also fiscal stimulus, typically putting money in people's hands, they spend that money at companies. I mean, typically that's also good for the market. And so what I'm saying is it's very hard to figure out the net effect as to, in a Republican administration, you probably get lower taxes and stimulus, but less stimulus. In a Democratic administration, you get higher taxes, but probably a lot more stimulus. So what's the net effect of that on the market? It's very hard to figure that out. I don't think any of us know. There's obviously going to be significant effects behind the scenes in terms of which sectors do well and which sectors do poorly. But what I was getting at there is, even if you think a certain, type of policy is good for the market, it's very hard to figure out which policy is going to be better going forward, whether it's going to be more of a stimulus driven higher tax type situation, or a, maybe a little bit less stimulus, lower tax situation. So assumptions you have as to what may have worked in the past may be changing now, because the way both parties implement policy is also changing.
Yeah, no, that's a really good point. Do you mind? I just kind of want to wrap it up and end it with, I'll just read the last sort of paragraph here from your article, because I think it pretty much sums up everything we're talking about. Can I do that?
Sure.
Or do you want to read it because you wrote it?
No, you can read it.
All right. So this is what you wrote. There's a lot at stake in this election. Many of us feel more strongly about the implications of this outcome than we normally would. But no matter how strongly you believe the world will be a better place if your preferred candidate wins, that doesn't mean the stock market will be. And our job as investors is to produce the best long-term returns we can for our portfolios. The ability to separate your political beliefs from your investment strategy is an important part of that. The stock market may go up after Election Day. It may also decline. But either way, if you look back 30 years from now and look at this election from a purely investment-based perspective, you are likely to see its importance in a very different light. Instead of seeing it as something that played a major role in determining whether you achieved your investing goals, you are likely to see it as a blip on the radar. So I think that really does a great job of capturing what we believe in, and I think how most investors should be thinking about this election, politics, and their investment portfolios.
Yeah, and I think just to sum up in the end, a good example of that is if you look back to previous elections where, I mean, maybe we could argue this is some of the higher stakes we've ever seen, but, Bush versus Gore was a disputed election. It wasn't settled for a while. Do you remember now? I mean, are there moves you think you should have made in your portfolio in order to deal with that? No. I mean, it's a blip on the radar. And even the Trump thing, when Trump was elected the first time, I mean, people saw all kinds of turbulence coming to the market, and, you ended up with a market that went up. So, the point is there's nothing you can do as an investor here. There's no adjustments to make to your portfolio. What happens may be good for the market. What happens may be bad for the market. Valuations and earnings and, all other things are going to drive that as well. But at the end of the day, whatever's going to happen, what will be the day after we release this podcast is not going to impact your long-term investment strategy. Your investment strategy should be the same the day after the election as it was the day before.
That's great. Okay. Thank you guys for listening to this. We will have this released one day before the election, so hopefully you get a chance to listen to it, and we'll see you next time. Thank you.
Thank you.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.